I see online where people just double down, take out like leveraged positions on stocks, they lose, and then they're like, crap, I've got to get out of this. And that is like a spiral that they get into. They're hiding it from their partners. They're hiding debts, losses, and worst case, it ends up in some pretty bad outcomes for everyone.
We are back in your life, and today we are talking about the 5 most common mistakes when you invest into shares. Michael, I must say today, great outfit. You are looking very rested. You're looking
hungover,
youthful. Why do you look so good today?
I slept in this morning, James. I didn't meet you at the gym.
I know, it was not at the 6 a.m. gym class. Brittany was there though.
So I might have had a headache.
Okay.
Maybe a self-induced headache.
Yeah, I did see
I went
your
out
car
with
in
real
the car
estate
park.
agents last night, and lawyers, and now I have a headache.
Yeah.
Well, but I look good, so that's all right.
Yeah, and you look happy enough. So let's get straight into it. So let's roast all those DIY investors and all the mistakes they make, Mike.
I know. And it's funny because every time we say something about this, they absolutely come for us. Like, you don't know what you're talking about. I've made all this money. And I'm like, yeah, okay, maybe some people have made some money at some point. Yeah, maybe they post about it online. But I'm like, why is everyone not driving Lamborghinis, still have a mortgage, still not living in mansions in Remuera, but you've made all this money on sharesies? Like, I don't know. It's so weird.
You know how I'm like, stay away from the comment section. It's starting to get a bit brutal.
Yeah.
I gotta be honest.
This one's gonna hurt.
I looked the other day, and one of the comments was, you know how we talk about like, if you're not analyzing the financials of the companies, you have no right to be investing in direct stocks. And they're like, what if I do? What if I can outperform the market? And I'm like, God damn it. And I want to clarify as well, people think I don't like sharesies. I got nothing wrong. Nothing wrong with sharesies. It's the decisions that people make on the platform. That's my issue.
Yeah.
Should we get into it though, Mike?
Yeah, go on.
Cool. Tip number 1. What have we got, Mike?
Chasing hot tips and trends. Look, so there's like your Reddit forums, right? This is your like, what's the Reddit forum, like the investing one? Wall Street Bets. Wall Street Bets. And they got Queen Street Bets. Yeah.
Yep. Look, I mean, you're full of trends, as we can see based off this outfit today.
Yeah, will I look back on this in 6 months and be like, damn, I look stupid? You look like Chandler Bing.
It is quite baggy, isn't it?
Baggy's a vibe at the moment.
Baggy's a vibe. Look, I mean, I work way too hard on this physique.
This actually isn't even that baggy.
Okay, so chasing hot tips and trends without any knowledge. So pretty much this is like you going like, AI, Mike, AI, we need copper for AI. We should go invest in a bunch of copper. And then people just run off and start putting money into things.
Yeah. I think the other one as well is like, even that decision of like, we need this, I'm doing some sort of analysis here. The worst one I see is on those like Reddit forums where it's just like, I'm investing in AMC because it's going to make money. And then everyone's like, okay, let's do that. And like, yeah. Like, there's like some market movements and people make some money, but it's that fool fallacy, right? Of just like, I might be an idiot for buying this, but I'm just hoping that there's a bigger idiot behind me who's going to buy it for more, right? And like, that's what I think a lot of this ends up being. And someone is always left holding the bag.
Yeah, I mean, the biggest thing I would say is this is just the classic, like, I want to get rich quick type mentality. And it's just the quickest way to stay poor for the rest of your life, really, is that it's about taking slow, consistent steps over time. So do not pick these like random companies that you hope will go to the moon. Make sure that you are consistent over time to get where you want to get to.
In saying that, though, I did pick, no. Cool. Number 2, a lack of diversification. But James, I'm invested in Nvidia and Amazon.
This is all about picking direct stocks is just such a silly game. Like the data on picking direct companies and making a profit is incredibly depressing. I think it's like 4% of day traders make money. You should not be picking direct companies. You should be investing into funds and diversified funds. Now, even I would say being, and look, much love to Warren Buffett in the game for a long period of time. The expression invest into the S&P 500 and just do that, that's bad advice as well. Because look at the US market, right? You've got an incredibly divided country with a stock market that has performed incredibly well for the last 10 years. Why wouldn't you have diversification to other parts of the world? Europe, emerging markets, New Zealand. You might go, why would I invest into New Zealand?
I would say that.
Yeah, there's some tax benefits investing locally. So that gives you, in terms of your return, there's some additional upside. Like having exposure to different markets. Yes, you might be missing out on, that additional bit of the AI and tech run because of what's happening in the world at the moment. But diversification is key. Do not try and outperform the market. Just take the long-term average.
Yeah, I agree with this one. I think that like on the diversification piece, if you are trying to pick direct stocks and diversify, you're like to invest in Alphabet or Meta or something like that, a really well-known, something like stock or company. Yeah, like there's a degree of safety there because they are so large. However, if you're then trying to diversify into like geographical regions and then into specific industries and geographical regions, like that starts to get very tricky very quickly in terms of like analysis, knowing a bit about the company, actually knowing what you're investing into. So the more you're trying to diversify, actually, like, let's say the company report is in French and you don't speak French.
Bonjour.
Then what?
Soissons.
Right? And I know you can throw in an AI thing, but like it just gets more and more difficult to do actual like credible research on companies if you're trying to diversify into like a lot of different regions, industries, areas.
Francois.
Right, number 3, trying to time the market.
Oh my gosh, this is the same with actually this is not just shares, this is property, this is everything. Thinking that you can try and work out a trend and therefore it is a good or a bad time to invest is just being, as my 3-year-old boy would say, you're being a silly goose. Do not do that. I mean, the interesting one that happens all the time, Mike, is that if you... I get people who go like, James, here's $1 million that you can invest for me, and I'll give you another $1 million, but we will see how it goes. And I'm like, okay, so like, just to be clear, what is the definition of like success or failure in terms of whether you invest the additional money or not? And I'm like, because if it goes up, everything's more expensive, and therefore, are you going to give me more money?
Surely a bit of that though is just like, I just want to know if I give you $1 million, I'm still going to be able to like call you in a month.
Hanover Finance.
Yeah, and you're not like, it's not like new phone, who dis.
Yeah. I do get those calls from time to time. But like, it's like if the market goes up, then it's more expensive. Yeah, if I lose you money, then you should be more excited to give me more money, but the human psychology behind that is really hard to get your head around.
Sorry, I didn't lose the money as in like it's missing. If the price of everything went down.
Just lose a bit of money, not all your money. So
where did it go? I don't know.
Yeah. So like, I mean, trying to time the market is just like the whole idea of, I mean, a perfect example was from 2008 to 2020, where the market continued to go up and people were like, they got to like 2015. They were like, it's a bad time to invest. The market's going to drop. There's going to be, the Greek bailout or China's growth issues or all these other things that might happen. So I'm going to sit on the sidelines and not invest. I remember very famously, to me, not famous to anybody else, when COVID happened.
Oh, yeah.
There was a client I had down in Dunedin who was a doctor.
Oh, I remember this. There was like a 60-minute special out of the US on this. It's very famous. Yeah.
He was, he had $1 million invested in shares and COVID happened. And he was like, COVID's going to go on for a long period of time. The share market is screwed. I'm going to move my money to cash. And obviously over the last 5 years, the share market has doubled. Yeah. Now, at that time of COVID, what was going to happen next? Who the hell knows? Yeah. But the biggest thing is you just can't try and time these things. It's just about whether the market's up, the market's down, taking long-term averages.
Yeah, an absolute iconic moment there from James. Cool. All right, so we have got 2 more to go and we will get into them after the break.
So we invest into shares. Why? Because we want to set ourselves up for the future. One of those key goals might be around retirement, but retirement is always changing, looking different, and it's very personalized for you. Do you need $1 million? Do you need $500,000? Do you need $3 million? What are the right assets to invest into? Well, we have a webinar Wednesday, the 29th of October at 6:30 p.m. You won't want to miss it. It's going to be a banger. Click on the show notes below. Now, back to the episode.
All right, James. Just before we kick off, do you have time to tell that yarn again? Oh, it was just so good. So
It was
iconic.
famous.
It was iconic. Yeah. All right.
Famous Canadian doctor.
Back into the tip. So number 4, investing while carrying a large mortgage.
Oh my God. People argue with me about this all
Yeah.
the time, and you are all wrong. You are all silly gooses. So look, if you're investing into, a lot of people have a mortgage, I've got a mortgage, you got a mortgage, you should have a mortgage, but you won't make a decision about your future. When it comes to investing in shares, you might make a 10% return. But your mortgage rate's 5.5% on average over the long term. People argue at the moment as well, mortgage rates are now 4.5%. They'll go to 4%. Got to remember, you got to think about the long-term average. When interest rates are lower, I'm pretty sure, Mike, nothing lasts forever. They'll go back up at some point.
Yeah. And I think those times are coming. I think we're bottom of the markets early, middle next year. And then after that, rates are going to go up. So again, when people are looking at this return versus this debt, you got to make sure you're doing it on long-term averages.
Hopefully that means some economic growth as well, but
we
will see. So essentially 10% on shares, 5.5% on your mortgage. You go 10% every day, surely.
I'd say that bet.
But once you take off fees, you're at 9.
9.
You take off tax, you're at 6%.
Tax.
And then there's this thing called cost of living increase.
Inflation.
Inflation. So then you take off another 3%, you're at a real return of 3%.
But
now
James, I was at 10. Why you do this to me?
Why you take all my money? So you might, get a little bit back in terms of fees and tax depending on what you invest into. But even if you're at 4, 5.5% is higher. You should focus on paying off your debt before you invest into shares.
Yeah, we get asked this all the time, and people often try and trip us up by saying, like, what am I meant to do? Pay down all of my debt before I do stuff. No, that's not what we're saying. But if you are carrying a decent amount of mortgage, you've got to make smart decisions instead of just trying to swing for the fences.
Yeah. Okay. So number 5, emotional decision making.
Never done it.
This can go.
Don't know what you're talking about.
You're a very emotional guy. See, let's see the tears on my shoulder from this morning. A lot going on in Michael's life. Now, when it comes to emotional decision making, there's quite a few different avenues it can roll down. The first one is if you did pick those direct stocks and they've lost value, but you don't want to sell them because otherwise you will crystallize your losses. So you will wait for them to recover in value. But Michael, a company, just because it drops in value, does not mean that one company will go back up in value. Yeah.
And again, it's a similar thing with I see online where people just double down, take out like leveraged positions on stocks. They lose, or on crypto, whatever it is, they lose. And then they're like, crap, I've got to get out of this. And that is like a spiral that they get into. They're hiding it from their partners. They're hiding debts, losses. And worst case, it ends up in some pretty bad, outcomes for everyone. So again, like the panic selling, the panic buying, panic decision making, the pressure to just don't put yourself in that position. If for some reason you are going to trade direct stocks after listening to this, do not take out a leveraged position. Please, at a bare minimum, do not take out a leveraged position.
What does a leveraged position mean?
When you are buying things using leverage. So I might put in $100 and I might take out a leveraged position and buy $1,000 worth of something, right? And the brokerage house or the trading platform is effectively lending me that money. That is a recipe for disaster. Because when you win, you can win big. But when you lose, you can end up owing tens of thousands of dollars, hundreds of thousands of dollars within seconds. It is not like a housing market decline. And they will call you out on it. They'll be like, cool, we're going to stop your position, right? And people often say, well, you leverage into a property, you can lose money in the property game. I'm like, yeah, but so long as you're paying the mortgage, the bank's not going to call the loan in. You will get to a position with your losses if you're taking out leverage positions on trading platforms where they stop you from trading and they go, you need to top up your account. We want some money. If you don't have $30,000 to top this account up, that's it, mate. You owe us $100,000.
Yeah, and the difference between like borrowing against property versus shares, you can borrow on a piece of land. Realistically, in most parts of the world, the value of the land is not going to drop more than 20%, right?
Yeah.
But a direct company, you can lose everything.
Absolutely. Yeah.
So please do not do that. The other one I do see from time to time is people inheriting share portfolios from their parents. I know would be nice. And they want to retain it because it reminds them of their parents. I don't know, keep something else to remind yourself of your parents. Don't keep shares that you don't understand. you should probably sell them down and do something else with
I
them?
got some shares that my gran gave me,
See?
and I just keep them. I don't know. It reminds me of my gran.
Yeah.
Yeah.
Can't you just get like a necklace of hers? Are you
Nah.
wearing a shirt today? Is that
No, like the reason, like my gran used to like love stocks. She like read the Herald, all of that stuff, like really into it. And
she wouldn't like this podcast?
no, she wouldn't. But like she just left me some shares. I'm like, I don't need the money. Like I'm not banking my retirement on this, but they just remind me of my gran, so I just keep them. It's not like $1 million portfolio or anything like that, which is like probably a bit more what you're referencing. It's just like, it's nice. I get my dividends every now and then. It
Yeah, how
reminds
do
me
you
of my
get
gran.
do you get the dividends? Do they come in the mail or do you just get like it show up in the bank account?
They email me. Yeah. It's like once a quarter. I get this little email. It just reminds me of my gran. It's nice.
Okay.
Yeah.
All right. Well, he's not listening to me, but hopefully you will listen to me. So there's the 5 tips of the mistakes that most people make when investing to shares. Do not be one of those people. Please subscribe to our YouTube channel. Give us a review. Give us a like, and we'll catch you next time.
Silly gaggle of geese.